Well, a lot to unpack there, so let's talk about exports and the coal shortages with Thomas Hayes, founder, chairman and managing member of Great Hill Capital. Always good to have you on.
Great to be back, Rochelle.
So I want to first start with your overall reaction to the import and export data for September.
Yeah, as you saw, the exports were phenomenal. They beat expectations, 28% versus 21% estimated. Imports were a little shy, 17.6 versus 20% estimated. But the China trade surplus with the U.S. actually rose to a monthly record of $42 billion. So as we look more closely at the imports, soybeans fell materially. They fell 30% on the import side. Purchases of crude oil declined 15.2%. So those were the weak areas. However, coal, which you referenced before, that surged. The import surged by 76%. The demand was there, and natural gas rose by 21.8%.
So then as we look at Chinese exports, then, which continue to shine year over year, break down the key factors behind that surge.
Yeah, I think the key reason that you saw exports beat while imports came in lighter than expectations is because the Chinese government actually started tightening policy, fiscal and monetary policy, earlier this year in expectation that the pandemic was in the rearview mirror, and it certainly looked that way in China, but the global pandemic was still roaring. And what happened is that tightening came earlier than the rest of the world. If you compare that to the U.S., we've grown money supply, M2 money supply, by 35% since January of 2020, pre-pandemic, whereas China started tightening early this year, and it's really hurt them. By the second half, the Chinese government saw the contraction in economic numbers and swiftly adjusted by reducing reserve requirements in the banks in an effort to help with liquidity, but more than that, also to boost lending to small businesses. So they did make an adjustment after 6 months, but the data has continued to get worse. So we saw retail sales were light last month. We saw the manufacturing PMI was in contraction. And that's leading economists to say that they're going to reduce the reserve requirement again, 50 basis points, either this month or next month, and possibly even lower the lending rate, the prime rate as well. And these two factors, lowering the policy rate and reducing the reserve requirements for banks, can really turn things around quickly. Despite the recent regulatory crackdown over the summer, that seems to be largely in the rearview mirror for the most part. And if they put these two accommodative policies back in place, we think that the economy will stabilize and really start to recover aggressively in time for the 20th annual Congress next year, where President Xi Jinping is set to take a third term of power.
And as you know, a lot of people looking to China to sort of revive that global economic rebound. But talk about how the global economic revival is helping fuel Chinese exports.
Yeah, well, the demand is there. And because you've seen the ECB and the Fed continue to maintain their accommodation, number one. Number two, you saw a difference in the fiscal stimulus. So whereas in China, it was mostly put into construction and industrial development, in the developed world, in Europe and in the United States, most of the fiscal stimulus went into the pockets of consumers. It was direct stimulus. So the demand for products from China has maintained strong. The liquidity from the ECB and the Fed has been ample. And that contrasts to China, which kind of tightened policy a little bit too early and now is reversing course. So they will catch up. So the exports, we're going to see continued growth in the developed world. If you look at the United States, for instance, just the S&P 500 is expecting 10% earnings growth, 4% GDP next year. So that demand, the exports will remain strong for China. And the imports should start to pick up as the Chinese government gets more accommodative once again in their policy and their economy picks back up and we start to see those economic numbers start to beat on a regular basis versus missing as of late.
Always great to get your insights. Thomas Hayes there, founder, chairman and managing member of Great Hill Capital.
Thanks, Rochelle.